I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome to the show, Bob.
Yeah, good morning, Jim. Good to be with you.
A disappointing U.S. jobs report has really hit the U.S. markets. Financials down 4%, or insurance companies down 4%. U.S. banks down 1.3%. Was it really that bad?
Well, I would say that the consideration of employment data has always been delusional. They're talking about, unemployment rate of, 5% when there's something like in the States 58 million people who give up looking for a job. But these guys get going, and they've had a trend whereby whatever they've done to the numbers, it's been, favorable, generally favorable. But underneath it all, a disaster. So because of it, so many people have fallen out of the workforce, just given up. So they're not considered unemployed, but they're not working. I don't understand. That's what I say. It's delusional. And I do believe that on each announcement, there's so many fudge factors in there, a monthly number, and, they adjust it for season and this, that, and everything. So the whole thing is, to be kind, delusional. But nonetheless, you had a number here that was distinctive and distinctively adverse. But you also at the same time had a number for May, New York State number. There's a number of these economic series that we really don't follow closely, have shown a sharp decline in May. So who knows what it means, but the market didn't take it too kindly. Stocks got dropped, and at one point I saw the bank stocks down in the U.S. down about 3%. And as you mentioned, some of the life company, insurance companies were down in the order of 4%. So they didn't like that. And then, of course, because they've got this really strange idea that the currency is based upon economic activity, the U.S. dollar has been marked down a little more than 1% today. Our view on the dollar is that it's back at the 1st of May. It seemed to have set a false breakdown there, where it dropped down to, whatever it was, and then there was the next day or so there was no follow through, and then it came right back up. So, and that was opposite to in January when with crashing commodity prices, the U.S. dollar was quite strong, and it did a false breakup out to the upside, and then a couple of days later, no follow through. So that was then the top for the dollar against crashing commodity prices. And our case has been that the rallies in commodities out of that very distressed January were from an extremely low basis, and then on a seasonal move. So often you can get a rally in copper to March, and that's what you had there. Often you can get a rally in crude oil out to, say, May or June, and we've had that. So you've had the swings in commodities, and corresponding to that, the swings in the dollar index. And our case has been is that the U.S. dollar would likely strengthen and continue to be strong, essentially based upon that in a post-bubble contraction, the senior currency eventually becomes chronically strong against most other currencies and chronically strong against most commodities for most of the time. So this latest rally, this is really a sharp hit to it, so it's probably short-term oversold. But we'll let it settle down for a bit here, but we're still looking for the dollar to be firming, perhaps for the rest of the year. And against that, you had the Canadian dollar, of course, rallied right up to 80 and became a little overbought. And, of course, it was for the usual reasons. You had strength in commodities, and these have, maybe had their best innings and getting a little sideways in here, a little weak. You had copper it was down to 204 the other day, and the low was a little less than $2. So it gave up most of the gains for the year. So the commodity side, other than the short squeeze in February and March and April, I think basic commodities. At the moment the grains are pretty strong, but they were slow to get started. They didn't start to rally until March. So then commodities can go down and test the lows of January, and that is going to be very uncomfortable for the stock sectors, the oil patch and the base metal miners. The base metal miners had a terrific rally out of the problems in January and became overbought, and they can drift down. So anyways, what this is I think the hit is against the dollar is probably for a few trading days. It'll probably stabilize and then start moving up, because there are other ways of looking at a currency other than the supposed vigor of its GDP. For example, I think one of the longer-term reasons why the senior currency gets strong in a post-bubble contraction is that most of the debt was written in the financial capital, which is New York, and it's due and payable into New York in U.S. dollars. So that the huge debt bubble that was done, sure, there was debt written in Europe and in London, but for this model to work, you have to have the senior currency whereby most of the debt would have been floated. And then the debt service charge activity is basically short covering. So this has yet to be seen. We want to get the U.S. dollar index through the 96 before it breaks out, and then once it gets through 96, then we can look at it at 100. And we've got a longer-term study so you can get up to 109, and the worst that it got to in January was that 100 level. So interesting times, Jim.
We'll have more with Bob Hoye right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Bob Hoye. Bob, one positive thing for the U.S., durable good orders were up 3.4% last month. Is that sustainable?
Well, the durable goods order, that one has always been volatile. Boy, it can really swing month to month. So, no, you've got other problems out there that I think that's a number that should be looked in isolation. And you've had a bubble in car buying, And the bubble side of it, of course, has been the way it's financed, where people are taking loans way out in time. And even second-hand cars were bought on the Never Never. So, and now in the last few months, car sales are slowing noticeably. And this one has been financed through the same similar way to that the housing bubble in 2006, 2007 was financed. Crazy stuff, packaging up of, and these are used car loans. So, you know, it's not a pretty picture. And, but the main thing is that the move was in the biggest part of the move was in the financial stocks, and you've had now for about 4 weeks the yield curve, which is the difference between long-dated treasuries and short-dated. It had been favorable for the banks and financial stocks. For the last 4 weeks, it has been unfavorable, but they were actually acting quite well until all of a sudden, bang, with this news item. Now, the other thing is that there are two aspects of the credit market. One is the curve, which we've just noted, and the other is credit spreads, which is the difference between credit qualities, between high-grade bonds and low-grade bonds, or between treasuries and junk. But that's been acting very positive, and since the panic in January ended, you had a large number of the oil patch companies were floated junk bonds, and then also there was a lot of other junk bonds done. So they had the disaster into January where the spread between high grade and low grade got out to 20%, and then that was extreme. So when you had commodities rebounding, you'd expect the spreads to narrow, and they have narrowed hugely, right into 14%. Latest posting, like yesterday's posting, and this has been an outstanding run of narrowing credit spreads, which has been a positive for the financials. But as of today, you've got a pretty smart rally going on in long-dated treasuries, and you've had junk and high yield marked down. So spreads are widening today. It'll take some work, but as we like to point out, the narrowing of credit spreads, there's a good seasonal component in it, and they generally come into around June, which is now, and they've really come in, and then we'll watch for some stability here. Today's day one, and it would have to be followed by a number of weeks of reversing and then a few more technical stuff. And we watched this very closely because it served us well in, for example, 1998 when long-term capital management was discovered to have traded the wrong way on both the yield curve and on credit spreads. And you had that disaster then, and it all hinged upon the credit spreads reversing in January to widening, and then it did in 2007, 2008. It served us very well there. And then going back to last summer, oh boy, that was absolutely fantastic, where we got the narrowing of credit spreads in a highly speculative condition, and the turn to widening, and then the breakout in July, which then, we take it, prompted the collapse of speculation in the Shanghai market. So the other thing that I also like to mention about the curve and spreads is where the central banks can push short rates down. The real world is the difference between short rates and long rates. That's, as I've said, there's the curve. And they have no control over the curve, and they have no control over the credit spread. If they did have control, then there would be no credit cycle and there'd be no business cycle. It'd be all one world of happy growth, but it isn't the case. So at any rate, you end up with this problem whereby a lot of investors have great faith in the skills of the Federal Reserve or the Bank of Canada and think that all is good. and they would never deliberately do an adverse policy. But the problem is that, of course, they really never do an adverse policy. What happens is the market forces takes it out of their hands and does the curve and does credit spreads. And it's, as of today, it's really doing credit spreads, and it's had the appropriate response in the stock market.
One of the members of the U.S. Fed has strongly hinted there will not be a rate increase this year and perhaps not for several years. What has that done to the markets?
Yeah, I don't think anybody knows. If you take a look at 300 years of the history of interest rate changes by the senior central bank and changes in the credit markets, they're usually, well, you can take it at times of great excitement, like when you're in huge financial swings and volatility. They're behind market forces. So, for example, in 1929, one of the indicators of a boom is short-dated interest rates going up. And one of the indicators of a bust is short-dated interest rates going down, of the senior currency, like Treasury bill rates. And in 1929, interest rates, the T-bill rate went up till it was April, May, then reversed and headed down. And then that was the warning that speculation was going to fail. So here, of course, this is all with zero interest rates. It gets a bit weird. But the history is that the senior central bank, at times of great financial volatility, have been behind the swings in market rates of interest. The job then of now the Federal Reserve is to carry off the pretense of looking like it's in charge. So these guys who are saying the Fed should lower rates, the Fed should raise rates, or it's not going to do this or that, it doesn't matter, because the Fed will end up following market forces rather than making market forces anyways.
Canadian banks reported profits. So much for a big hit from the energy sector, or is that yet to come?
Well, they call it the National Bank in Canada. It reported something like a 48% drop in profits for whatever period it was reporting on, and largely due to writing down loans in the oil patch. So you actually, so this is, you've got a very good, sound banking system in Canada, but the banks themselves will go off if it's a hot industry, they'll want to lend money to it. And not so long ago, crude oil was very hot, and they had to lend money to it, and then it goes bad. But reminds of the crash in energy prices in the 1980s, where everybody was in on lending money to oil companies, and there was one young banker. Of course, the money all went away, and there was a young banker from Oklahoma, and of course, once the money disappears, then you get officialdom in on it, and I don't know whether it was a congressional hearings or what, but anyways, there was an inquiry going on. So they asked this young banker, well, where did the money go? And then as the Wall Street Journal actually reported it, he said, well, it went into wine, women, and song, and the rest of it we just pissed away. It was one of the best stories I've seen in the Wall Street Journal. So this is what happened in the oil patch here. The oil prices go down. The money that was lent to the oil patch is a problem getting it back, and and that happens in any industry where you've had excessive prices in the underlying commodity. Like the base metal sector has been under a lot of pressure since the cyclical peak for base metals in 2011. So on looking at some of these resource things, we've been very positive on the precious metal sector, because our study in November was that as the sector bottomed towards December or maybe into January, that would be a cyclical bottom. It would end the long bear market for precious metals that started in 2011. And indeed, things fell into place. The gold stocks began to outperform the bullion price, and gold stocks began to outperform the S&P, which was needed. So then, boom, and then bang, it exploded. Everybody got in. You had one of the senior gold stock indexes, the Hoye. Its low in January was 99, and then I think the high was about 236. So it's done a sort of double high in here, and correcting. Silver is correcting as well. It's come down below the 50-day moving average, which is an indicator. Sure, they have a good day today, but we've been thinking for the last 3 or 4 weeks that the precious metal sector, which has been outstanding, is in need of a correction, and it's generally underway. It could last for a bit yet, but on the long term, this should be emphasized that the precious metal sector is in a cyclical bull market, and it'll be in a cyclical bull market until the charts tell us it's no longer there. So this could go on for some time, maybe a year or so. We'll enjoy it as we go through it.
Bob, thank you very much for chatting with us.
Jim, good to be with you. Look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. You can forward questions or comments to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.